We don't want to exhaust
Patience.
I'm going to start with one more announcement. You will by now have noticed that there are some papers, hard copies of the papers out in the lobby near where we're having our snacks and so on. We didn't photocopy a lot of copies of these. They're online, and so I would ask that you mostly access them online. This is a very communal group, so you know, as you finish a paper, if you could put it back, you know, if you're all right with doing that, it's online for you, so you can always access it that way. Just put it back, and then someone else can take a look at the hard copy as well. As I say, you know, we had 10 copies of each of the papers made, and I just am trying not to overburden our photocopying here. So let me introduce our next two speakers, and I understand they're going to go one after the other, so split the paper somewhat. We're going to begin with Tom Humphrey, who many of us know from attending the History of Economics Society meetings and so on. Tom has been a research economist at the Federal Reserve in Richmond for many years, for 35 years. He retired in 2005. And he, for those of you who follow the Richmond Fed's academic journal, you will know that he was responsible for that for many years. I believe that, I'm not sure, but I think that the first History of Economics Society meeting that I attended, which wasn't in Toronto, was at the University of Richmond in 1989, although it might have been 1990, but somewhere around there. 1989, yes, thanks Kevin. And that's, I think, when I met Tom Humphrey, so it's been a long time. We have as well Tom's co-author, Richard Timberlake, who is a professor emeritus at the University of Georgia, and who has written widely on the history of monetary institutions in the U.S. So please welcome our two speakers as they continue this theme of financial crises historically considered.
Thanks are due to Sandra and David for inviting us to this summer institute, which is devoted to the preservation of the history of economic thought. And I think preservation of the history of thought, or history of thought, certainly deserves preservation because it's a source of much insight and wisdom, but a lot of which has been lost or overlooked or forgotten, and is just waiting around for the doctrinal historian to rescue it from oblivion and restore it to its proper place in the current conversation. Fortunately, however, some ideas from the history of thought were never lost, but have informed economists from their very origin up to the present. And one such idea is the classical theory of the lender of last resort. That theory originated in the first part of the 19th century in England, when England temporarily suspended the gold standard during the Napoleonic Wars. Essentially, the lender of last resort theory is a set of rules that tell the central bank how to avert bank panics and crises and bank runs, and in this way how to protect the money supply from sharp contraction that would disrupt the payments mechanism and put deflationary pressure on the economy and since some wages and other costs tend to be temporarily inflexible, this deflationary pressure would cause a fall in output and employment. So it was very important for the central bank to follow this set of rules. Well, today the classical theory of the lender of last resort continues to form the benchmark of all central bank lender of last resort policy, including the Federal Reserve, of course. And that's true even though the Fed honors the classical lender of last resort theory much more in the breach than in the observance. Indeed, since the Fed devised the arranged takeover of Bear Stearns by J.P. Morgan Chase in the spring of 2008, it has, in its lender of last resort initiatives, gone far beyond what the classical formulators would have condoned. But even so, the Fed takes the classical model as its jumping off point or as its baseline, but then it goes far beyond that, or has gone far beyond that. So what I'm going to do, we're going to practice specialization and division of labor in this, and I'm going to cover the classical model, and then we'll fast forward to the present, and Dick Timberlake, my co-author, has a comparative advantage in criticizing the Fed, so he's going to do that. He was outside the Fed while I was working in it for 35 years, so I perhaps had to mute my criticism and muted it too much. I don't know, but anyway, he's got the comparative advantage in that. So Dick will then describe how the Fed, with its much expanded version of the lender of last resort, has departed from the classical model. And basically, we contend that the Fed's current deviation from the classical model is problematic, cause some problems, and have potential to do more harm than good. And we suggest that the Fed maybe should rein in its ambitions and return to the classical prescriptions. It should perhaps do what the classical is advised, but no more. That's just anticipating some of the things that Dick's going to say. Well, covering the classical theory is straightforward because it was primarily the work of two Englishmen writing in the 19th century. So you don't have to, there are other people that talked about the lender of last resort, but basically it was the basic framework was established by two Englishmen. The first one was Henry Thornton, who wrote it the first part of the century, as I said. And he was a banker and also an evangelical reformer. And David, wasn't he the chairman of the Sierra Leone Society or Sierra Leone Company? Anyway, that was designed to establish a new colony for runaway slaves who had settled in Canada, I think, for a while, and then they were going to establish a colony in Africa, and there were people in these evangelical reformers in England that were going to finance it. So anyway, that was another part of Henry Thornton, but he was mainly a banker, a member of Parliament, and above all, a world-class monetary theorist, all-time great monetary theorist. And he published his ideas in a book published in 1802 called An Inquiry into the Nature and Effects of the Paper Credit of Great Britain, long title. Now everybody just talks about the paper credit of Great Britain. It's his great book. Shortened version. The second second economist, was Walter Bagehot, who was a financial writer, historical economist, and he was the second editor of the Economist magazine, and he edited it for a long time. I think maybe 30, 40 years. But he wrote throughout the 1840s, 50s, and 60s, and published his greatest book, which all his basic ideas on the lender of last resort are embodied, in 1873, and that book was entitled Lombard Street, a description of the money market. Well, when Thornton and Bagehot laid down for all future generations the classical theory of the lender of last resort, the first thing they did was to explain what a lender of last resort is and what are its unique features that give it the power to be a lender of last resort. And the lender of last resort, they said, is the economy's ultimate source of liquidity. It can provide extra money, so-called base or high-powered money, in the form of cash of ultimate redemption. And back in those days, this money of ultimate redemption was either gold or Bank of England notes. The notes of the Bank of England were considered to be as good as gold. And so those two things constituted the monetary base. There were other monies in existence and notes produced by country banks and that, but the Bank of England's notes were considered to be as good as gold. So the lender of last resort has the power to create base money, and also part of this base money forms bank reserves upon which commercial bankers, country bankers back in those days, called country banks, create banknote and check deposit money. Not so much check deposit money which you have today, but note issues, but still there was some deposit money. And that money of ultimate redemption is available from no other source. It's just available from the central bank. So the central bank, therefore, is the monopoly producer of high-powered money, and its distinguishing feature is that it can produce base money without limit, never runs out, and it can do so quickly and vigorously as the needs arise. That's what the primary purpose or primary distinguishing feature of a lender of last resort. Now, having explained this feature of the lender of last resort, Thornton-Bagehot then got down to brass tacks. They spelled out first the job or purpose of the lender of last resort, and second, the exact rules it should follow in achieving this purpose or this job. And the job or purpose, of course, was to ensure stability in the nation's money stock, and thereby the purchasing power of money in the face of shocks to the economy and to the financial markets. You know, today Ben Bernanke and other people talk about stabilizing credit, and they talk about the lender of last resort's main function is to see to it that the banks start lending again. It's bank loans that the emphasis is put on. And back in the classical days, the emphasis was not on credit, not on bank loans so much, although they recognized credit was very important. But they thought that the main thing that the lender of last resort should do is to protect the money stock, stabilize the money stock in the face of shocks to the economy, and thereby you stabilize the price level, you stabilize the payments mechanism, and if you stabilize those three things, you've gone a long way to stabilizing the whole economy in the face of shocks. The job of the lender of last resort, according to them, was not to prevent shocks to the economy, and that's impossible to do in many cases anyway, but to keep those shocks from spilling over into the banking sector where they would cause sharp contractions in the money stock. So, you know, the lender of last resort comes in after the initial shock has occurred, and it tries to prevent the shock from being transmitted through the system and destroying parts of the money stock. The main shocks that Bagehot and Thornton referred to were things that we don't quite have today, such as crop failures. Well, maybe we do. Crop failures, rumors of foreign invasions into the country. You know, when Thornton established the doctrine, there was a rumor at the time that the French were going to invade Great Britain, the British Isle, and that, you know, could cause a lot of disturbance. Or the failure of a big bank or a big business, things like that. Well, they said those shocks would precipitate bank panics and cause runs on the banks. Runs would occur when, say, depositors fear they won't be able to get their money out of the troubled banks, and when note holders of the notes of the troubled banks, feel they won't be able to redeem their notes with money of ultimate redemption, won't be able to redeem them and get money transferred into the form of gold coin or Bank of England notes. Well, as I said, the result of such panics is a sharp increase in the demand for base money as depositors and note holders seek to convert their notes and deposits into hard cash for withdrawal, and bankers seek extra reserves both to accommodate the cash withdrawals and to allay suspicion that they're running out of reserves. And in modern language, you have this thing that which Friedman and Schwartz established, this thing. Says it relates the money stock to the monetary base by this money multiplier, which is a function of the public's desired ratio of hard cash, base money, gold or bank in the notes, cash, ratio of cash to notes and deposits, and the banker's desired ratio of reserves to notes and deposits, and you multiply that by the monetary base. And so what Thornton and Bagehot said in effect, they didn't write out this formula to say this, but in effect they said it, was that it's the, during panics, these ratios rise. The banker's desired reserve ratio rises because he wants to allay suspicion that he's running out of reserves. He wants to have enough reserves to accommodate cash withdrawals. And of course, the people who have deposits in the banks or hold notes in the banks want to get their deposits out and their notes out in the form of hard cash. So their desired cash deposit ratio goes up. That causes the whole money multiplier to go down. And if nothing is done with the base, that would cause a sharp contraction in the money stock. Well, it's the function of the central bank or lender of last resort to offset fall in the multiplier with compensating rises in the base, and thereby stabilize the money stock and stabilize prices and the payments mechanism, and then thereby the real economy. So you can read that very easily, especially into Thornton. I mean, he really didn't use a formula, but he said it in so many words. There is another thing another point they made, is a very strong, important point, is that it's not enough. What the purpose of the lender of last resort is also to make known to the public in advance of any future crises that it's always going to do this, that it's always going to stand ready to stabilize the money supply when you have a panic-induced falls in the multiplier. It's always going to do it. It spells out, it pre-commits in advance to do this in all future panics. And it advertises this. And the public, knowing what the central bank is going to do, then that mere knowledge itself may avert panics before they even start, because the public says, well, we know that the central bank or the lender of last resort is going to come in and see to it that there's enough liquidity, increase that base money, and so everything's going to be all right. So we don't need to do those runs on the bank. So the mere announcement of this fact, pre-commitment, is maybe enough to avert some panics. So that was a very important point they made, and Bagehot especially really emphasized that. Thornton and Bagehot next said that when the panics threaten the money stock and the banking system, the lender of last resort must make base money available to the market in general, or the market Leland is right. You shouldn't talk about the market as doing all the actions. Market participants that do it. So make money available to the market participants in general, not to specific targeted firms. The lender of last resort in their days ejects base money either through, ejects it through discount window lending, but it could also do it through open market operations. And today, open market operations would be the preferred way for the lender of last resort to operate, in which the Fed operates. And the reason why Thornton and Bagehot didn't advocate open market operations as a means of making liquidity available to the public in times of panic was because open market operations weren't very widely used back in those days. Sure, they did buy some exchequer bills and buy and sell exchequer bills, but that wasn't done very widely. So it was loans through the discount window that was the way money was put into the economy. Anyway, the idea is to make the funds available to market participants in general, so those market participants themselves can allocate the money to its highest and best use and decide which banks should fail and which banks should survive. Let's assume in the rest of this analysis that the lender of last resort makes money available through the discount window rather than through open market operations. That was what it was done in Thornton-Bagehot state. Well, then they next prescribed that the lender of last resort must lend to any and all solvent but temporarily illiquid borrowers. And you get the distinction between illiquidity and insolvency. They didn't want the lender of last resort, of course, to lend to insolvent firms like AIG or Citicorp, but they wanted the firms to be. The idea was to prop up those banks that were temporarily illiquid, but they were solvent. So make your loans available to solvent but temporarily illiquid borrowers who offer good collateral readily saleable for more than the amount of the loan, and willing to pay an above market interest rate for the privilege. So lend to solvent borrowers who are temporarily have an illiquidity problem, but are willing to offer good security, good collateral, and are willing to pay the penalty rate or the high rate that is charged. Now, the key thing about these lender of last resort operations was anonymity. And anonymity keeps the lender of last resort from channeling aid to politically favored borrowers. What the lender of last resort says, in effect, is this: we don't care who you are, just give us sound collateral, pay the penalty rate, and we'll give you all the money you want. And I got to say this: the idea was that if a bank can, or a borrower, potential borrower, can offer sound collateral, good collateral, that in itself kind of gives you a test of his solvency. So that's what they said. As I just reiterate, the good collateral rule ensures that the lender of last resort won't lose should the borrower default and the lender of last resort have to sell the collateral to recover the proceeds of the note of the loan and accrued interest. And the rule, as I said, also provides a rough test of the solvency of the borrower, because the idea is that if the borrower is insolvent, he wouldn't have enough assets to be able to tender them as good collateral. The purpose of the penalty rate, you charge a high rate, is to encourage prompt repayment of the borrowed base money once the panic ends, so the money stock would return to its stable, non-inflationary, non-deflationary long-run path, consistent with constancy in the price level. Second, the high rate, penalty rate, deters borrowers who don't really need the money from applying for lender of last resort aid. You don't want people who don't really have emergency need for the money to borrow it, just out of precaution. So you deter them with a high interest rate. Third, the high interest rate encourages banks, would-be borrowers, to exhaust all market sources of liquidity, and even to develop new sources before coming to the lender of last resort for aid. So it's a pro-market mechanism. And having laid down these rules, namely pre-commit to lend without stint to market participants, whoever they are, take good collateral only, and charge a high interest rate, Thornton and Bagehot highlighted what a lender of last resort must not do. And it must not target loans to individual borrowers judged too big or too interconnected or too important to fail. It must make loans available to the whole galaxy of market participants, not to specific favored borrowers. And it certainly must not take questionable collateral or charge subsidy or below market rates, which is what the Fed does now. It takes junk collateral and charges, in some cases, below market rates. And one can only imagine what Bagehot and Thornton would think about the Fed today. I think they'd be spinning around in their graves like that, you know. Anyway, the next thing, as if this wasn't enough, the next thing the classical writers did was to take account of the moral hazard problem facing the lender of last resort. And of the two writers, Bagehot and Thornton, it was Thornton who was more explicit and wrote more about the moral hazard problem. And he said that when the lender of last resort, if it makes its accommodation available on too generous terms, it'll create incentives that will encourage lax and reckless behavior on the part of other banks and other institutions, and so it will create even more systemic risk. You know, you try to bail out a firm today, and you create even more systemic risk in the future, as Leland talked about, and then so you've got a real problem down the road. You may try to avert a problem in the short run, but it'll lead to a bigger one later on. And so Thornton's solution to this problem was to advise against bailouts of banks whose distress arises from their, and these are his words, whose distress arises from their own rashness, their improvidence, or their misconduct. And those are his words. And he says such bailout operations would subsidize the risk of poorly managed banks and encourage other institutions to take excessive speculative risks without fear of the consequences, because they know that they'd be bailed out if their risk turned sour. And so you really create a problem, and Thornton was very much aware of that. And so basically, they said that the function of the lender of last resort is to lend vigorously to the market so that all sound borrowers who really need the money can get it, but lend on fairly restrictive terms, good collateral, penalty rates and all that, so as to discourage moral hazard. And finally and lastly, Thornton noted that the lender of last resort policy is not separate at all from the central bank's monetary control function. Some people seem to think that. They say, well, we know about the monetary control function of the central bank, but lender of last resort policy is a deviation from that. And Thornton and Bagehot certainly didn't think so. They thought that the lender of last resort function was part and parcel of the monetary control function. Now, as you all know, the monetary control function calls for the central bank to keep the stock of money on a stable, non-inflationary path, and that's consistent with price level stability. And as part of that function, lender of last resort policy calls for the central bank to be prepared to temporarily increase the monetary base, as I said, so as to prevent panic-induced deflationary falls in the money stock from its stable long-run path. Now, as for why the LLR, lender of last resort, wants to prevent deflationary collapse of the money stock, Thornton was very sophisticated on his analysis of this. He said that, didn't believe in the short-run neutrality of money at all, believed in short-run non-neutrality of money. Said that if the money stock falls, because some costs of production and wages particularly are temporarily inflexible or sticky, downwardly sticky and inflexible, that when you have fall in the money stock and a deflationary pressure on the economy, because wages and costs don't fall under the impact of that deflationary pressure, real variables have to take the hit, have to do the adjustment, and those real variables are output and employment, so that causes output and employment. So in a word, money stock contraction causes deflationary pressure, which causes recession. And that's why Thornton wanted to, and Thornton-Bagehot wanted to, the lender of last resort, to stabilize the money stock in the face of shocks to the economy. Well, the central bank, Bank of England, in Thornton-Bagehot's England, in their country, learned the classical lessons well. And there were very few bank panics in Great Britain for the remainder of the century after 1866. I don't think there were any. But the Fed failed to apply the lessons to the banking panics in the early 1930s. It didn't apply the lender of last resort lesson at all. And the result was a disastrous, widespread bank failures in the United States and a 33% contraction in the money stock. And this contraction, which is unprecedented in its scale and severity, either caused the Great Depression, as some people think, or if it didn't cause it, it contributed. It was a mighty contributing factor. Well, I'm now going to jump to the current situation, and where we find the Fed has expanded its role as a lender of last resort beyond the classical, what the classicals would have agreed upon, and Dick is going to take it from here.
Thank you, Tom. And thank you, Sandra and David, for inviting me. I want to develop a little bit of history on the central banking concept. Like the Bank of England, the Fed was grafted onto the gold standard after the gold standard had been working for the better part of a century. Central bank and gold standards both control the stock of money. So for the gold standard to endure, the Fed had to subjugate itself, as the Bank of England had done for a good part of the 19th century. However, a central bank, now I should stop here and mention the fact that central banks were not formed as central banks. That applies both in England and the United States. The Bank of England, nobody said, let's form a central bank. And they all got together and said, well, let's wait and see, what's the central bank going to do? Far from it. The word was never used, and for the better part of the 18th century, the Bank of England didn't carry out any central banking functions. It was simply a bank that the government had created to help it finance its expenditures, its wars of this sort and that sort. And it was an extra large bank, and the government used it as a bank. But it was also a commercial bank. And so, like, it was both a commercial bank, a government bank, and then occasionally something would happen, and it turned out the Bank of England had all of the reserves, the gold primarily, and it was called upon to act as a central bank without anyone having given it that label. Well, the second bank of the United States was of the same character. It was not created as a central bank. It had, in fact, both Congress and Parliament were very much averse to central banks. And so was a great deal of polity in England and the United States. And in fact, Andrew Jackson gave the second bank of the United States its quietus as a central bank when he vetoed its recharter. Well, that's another long story I've been working on recently. But the main thing I want to say is that central banking came in the back door to the institutions that were already there. Now, if both a central bank is in place, a partial central bank, and a gold standard, you have two institutions that are controlling the stock of money. And that turns out to be a bureaucratic improbability, which became a bureaucratic impossibility, as bureaucracies always win over other institutions. The Fed was also supposed to be subordinate and to be a lender of last resort, as Tom has discussed. But its principal functions at the time it was developed or turned into law and discussed in Congress was to provide form seasonal elasticity to the money stock. That is, it was supposed to provide, as Tom suggested here, with currency and reserve ratios, it was supposed to be able to supply money so that any change in demand between the form of money as currency and the form of money as demand deposits would not have a substantial influence on the total quantity of money. Congressman didn't put it that way, but that was the understanding. By the time World War I had come along, and I might say that up until World War I, the gold standard was working, what Jim Buchanan called a dollar now and a dollar then and a dollar forever, was both prominent in the United States and in England. And there's an interesting passage from Keynes that I won't try to quote, but it discusses, Leland in fact quoted that about how nice things were before 1914. And then came World War I, which we all want to repeal, as Leland has suggested. But after World War I, the Fed was in place. And during the World War, it had established its offices and some of its bureaucracy. And there were 12 Federal Reserve banks. That was the difference between 4 and 48, one for each state, and the 4 major centers for the national banking system that existed prior to World War I, prior to the Fed. But as World War I ended, the Fed promoted a 3-year inflation between 1918 and 1921 in its efforts to help the Treasury finance World War I. It alone was responsible for the inflation, and most of it came after the war had ended. But by 1921, the polity in the government of the United States had sort of shifted toward letting the Fed alone to do what it was supposed to do. But also by this time, and that means take the Treasury out of the garden of the Fed and let the Fed perform as a lender of last resort. But by this time, the Fed had almost had a huge amount of gold that had come into the United States from Europe primarily to help the Europeans fight World War I. So with all of the gold in place in the Federal Reserve banks, how was the Fed going to act as a lender of last resort? It had all of the gold, and the banks hardly had any, although they had gold reserves balances with the Fed. However, the Fed had not been formed. It didn't have any provisions for this kind of operation. And this is where Benjamin Strong came in. He was president of the Fed Bank of New York, and the Fed Bank of New York was right at the heart of the financial operations of the country. And Benjamin Strong decided, in conjunction with some of his advisors, I presume, although he usually gets all the credit for this, to maintain a stable price level. He didn't put it that way. He didn't say, we're going to maintain a stable price level, but he put it in roundabout form, and that's the only implication you can get. And particularly, the operations of the Fed Bank of New York from 1922, when Strong became the prominent leader, until late 1928, when he died, the price level in the United States was as stable and as flat in terms of change. It didn't change at all to speak of. It was as stable as it ever has been, or probably ever will be. And there was no inflation in the 1920s. I want to emphasize that, because you constantly hear in today's news reports about the inflation of the 1920s. There wasn't any. There was an inflation in the stock market, but that's not the whole economy. That's just the stock market. And so it should have inflated and deflated, and the rest of the economy should have gone along and absorbed that little bit of disequilibrium and straightened things out. However, Benjamin Strong died, and by this time, the lender of last resort picture, the function of the Fed as, was completely gone. And the man who got in charge after a palace revolution of sorts was Adolf C. Miller, who was on the Fed board. He was appointed by Woodrow Wilson on the original Fed board, and he was reappointed to the board in 1924 after his 10-year term expired. So he was a prominent member of the board and did a lot of Fed writing on the policies of the Fed. But he was by all means an inveterate and confirmed real billser. That means he believed in the real bills doctrine, which was a primary philosophy behind the formation of the Fed. Now, I won't go into what the real bills doctrine is, other than to say that it tries to provide a theory for the creation of money to accommodate the creation of real goods and services. But it also has a black side. And the black side is that it's firmly opposed to several kinds of lending: long-term lending, mortgage lending, government securities, and above all, stock market speculation. Well, A.C. Miller was an evangelical opponent of speculation, and he managed to convince the Federal Reserve Board of 9 members to go along with this anti-speculation policy. And that's what caused, I don't say just contributed to, that's what caused the Great Contraction, which turned into the Great Depression. And it went on, Miller used the device of direct pressure, which means that they set a discount rate, but if the bank that applied for loans from the Federal Reserve Bank didn't had any kind of stock market speculation attached to it, it didn't get the loan no matter what interest rate it paid. Well, the Great Contraction turned into the Great Depression, and a new era came into central banking. But by this time, the lender of last resort idea was long gone. The Banking Act of 1935 made the Federal Market Committee and the Federal Reserve Board the dominating part of the system, so that the Fed had complete control of the quantity of money, which doesn't leave anything for any lender of last resort institution. And so the Fed has always been a lender of last resort only in name. Ever since 1921, it's been an institution of monetary control. And it's occasionally shown some evidence of being governed by the gold standard, but that was more of an inhibition to the governors of the Fed than it is in has been in effect and in fact. So the Fed has been and is now an institution that's all omnipotent in the control of the quantity of money. So what is the final solution? The final solution must be a monetary rule of law that would take the power out of the Federal Market Committee, a committee of 12 people who are not infallible and who are not outside the pressure of political factors, so that the Fed would mimic the role of the gold standard. And that's where I think Jim Buchanan and Leland are both making contributions, especially, well, both. But whatever we had with the Federal Reserve System has not been a lender of last resort, except occasionally and inconsequentially. I might say that I remember, Jim is the only one who remembers Abel Lerner's hydraulic machine. I remember it too, but I didn't see it. I remember the incident of all those different economists having these flow-through models to show how the economy worked. I don't know whether they ever put money into it or not, but they should have. Well, that's the substance of what I have to say. Thank you very much.
The relationship between being a lender of last resort and being a bank regulator, and especially something that hasn't been mentioned yet this morning, but I associate with Virginia, and that is rent-seeking and all kinds of opportunities for that. And it seems to me the response has been, oh, we need a magical rule. But that's wishful thinking in the real world. So what I'm wondering is, if you have bank regulation in one institution, how do you think you're going to solve the political problems for that with a simple sacred rule, as if human beings are devoutly God-fearing of this rule? I mean, the whole history of mankind suggests against that. So it seems to me, I haven't heard anything this morning that gives me hope for a solution.
You know, I don't, that's a very, very fine question, and I don't know the answer to it. The thing is, I don't think that the classical writers really addressed it. I think they thought of the central bank or the lender of last resort as being the controller of the paper component of the money stock, and they thought this, as for rent seeking and things like that, they thought that this anonymity procedure combined with penalty rates, you know, people couldn't do much rent seeking in order to get, you know, in order to get the loans, because they realized that the lender of last resort says just show up at the discount window with very good collateral so generous that it'll more than cover the amount of the loan, so that if you default, we can sell that collateral and recover the proceeds. Also, be willing to pay the penalty rate, and we don't care who you are, just slide that collateral under the discount window. So that kind of minimizes rent seeking there, and the high penalty rate does too. So I think they thought that they really wanted to reduce and minimize that kind of thing. But as for the relationship between the monetary control function, which includes the lender of last resort function, and this bank supervision and regulation, and the looseness there, and the passageway whereby you can wiggle around and maybe do all the things you're suggesting, I don't think they adequately addressed that. The classicals didn't. I don't think. I think they would have said that was an excellent question, and we do the best we can with the penalty rate and the anonymity procedure. But that's what the classical writer said. But what do we do about it today? I mean, that's a very good question.
Well, are you asking what could be done today? Is that?
Well, so I was curious about gospels, but I'm also curious about today, and that it seems to me that if we don't look at the deepened institutional enmeshment of banking supervision and bank regulation with monetary policy, and we only start creating solutions on one end of the problem, we're sort of being very naive. And what I heard in your talk was only a focus on the sacred rule side, ignoring the institutional and constitutional framework in which banking operates. And it seems to me that the kind of sacred rule solution actually is liable to more abuse given the institutional framework we're in.
Well, there was
supervision and regulation.
Yeah.
Well, the Fed, you know, the Fed is a hedgehog, not a fox. It can only control the quantity of money. It does not control interest rates. That idea about interest rates is developed because the average householder has a mortgage, so he understands interest rates. He doesn't know the machinery of money, how money is created, especially the banking system, and especially after that, the central banking system. So it's almost impossible to argue with people about that, but they're so adamant. I have friends that want to tell me the Fed controls interest rates, and I.
Well, not only that, you know, the idea is a hedgehog knows one big thing, and the clever fox knows many things, and everybody thinks of the Fed as a fox. It can achieve all these goals, and we should give it more tasks. You know, make it the super regulator now to make sure that there's no systemic risks involved in the future. You know, we don't think that the Fed can do that. The Fed knows how to do one thing, like a hedgehog. You know, the hedgehog knows the one thing it knows how to do is to curl itself up into a spiky ball when the predators come. So it knows the one thing that will enable it to survive. The Fed knows how to control the money supply, and that's what it ought to be. Fed's job is monetary policy. It should not be given all these supervisory stuff that you're talking about. I think should be sheared off from the Fed and given entirely to some other agency. And the Fed, because it creates the tension that you talk about. And so we see the Fed as a hedgehog.
Amen, brother.
But not a fox. But the rest of the world sees the Fed as a fox, a clever fox that can do everything. So give it more goals, give it more things to do.
We had a conference here at the end of January, and one of the economists argued that the Fed should now become the insurer as the last resort of the last resort.
Insurer of what?
Of
But it kind of is for Citicorp. It guarantees Citicorp's debt, you know, above a certain amount, which the Treasury guarantees. So those guarantees are really kind of insurer of last resort.
Yeah. David.
When we think of Thornton today, we think of one of the great monetary theorists of history, but he was also Wilberforce's theologian.
Right.
And Hayek tells in his introduction, his great vision, how he found the Thornton in a bookstall, picked it up, he was excited, and he said, "Oh, it's family prayers." With that. And so one of the things Wilberforce's circle did was to find the way to buy out slavery, so that they were able to find a rule to make a deal so the Brits got rid of slavery without having to go through Antietam, which is a real good place to avoid. And so maybe there was something in the embeddedness of thinking about Thornton in a general equilibrium context. He's not just a monetary theorist. He's a monetary theorist who comes out of the great moral theological movement against slavery. And so maybe in that context there is a rule that we can recover if we look for it. But if we don't look, we won't find it.
So there was no question?
No,
Just checking.
Actually, if I could follow up on
Okay,
that. So you described Thornton as a theorist, and monetary theorist and so on. I don't know that much about Thornton, but in the text here he's described as a banker, a member of Parliament. Bagehot, I know, was basically a policymaker, and it raises a more larger issue. Looking back at these guys, do we have more confidence in them because of their real-world policy experience or their economic theory, which we, based on the first talk, is this going to be just a lot of naked emperors coming up with rules that maybe we don't really trust? So there's that element. The other aspect I'd like to ask you about in terms of what we can learn from looking at history of economics in this and the current crisis is there could be the response that the current financial system is just so complex and so vastly different. This is the argument often made about doing these sort of unprecedented things, that we just sort of have to try these things. We can't really look to the past. That, because the financial system is really going well beyond what's in the traditional banking system.
But the only thing about that is you go back and read Bagehot's Lombard Street. He has pages on pages where he talks about the interconnectedness of parties and counterparties, and when one guy fails, that'll really cause the other guy who's holding his assets to weaken. So he was very aware of this systemic risk caused by the structure of interrelationships. And maybe it didn't exist to the extent it does today. Of course it doesn't. But he was very aware of that, and he still said, because of his great wisdom as a practice. Back in those days, by the way, there wasn't. You could be an economic theorist and also be a man of the world, and write for the financial journals. And you could be interested in theological matters too. So so they knew a lot more than just pure theorizing. They didn't specialize in that completely. But anyway, so Thornton and certainly Bagehot was aware of this interconnectedness, and he still didn't buy the argument that Leland made so well, that because of this interconnectedness, you have the short-run problem that you want to avert, and maybe we have to bail them out, even though it leads to long-run moral hazard problems that makes the problem even worse in the long run. But Bagehot especially said, I know about this interconnectedness, I know about systemic risk, but if a bad bank is bad, poorly run, and is not only illiquid, but is insolvent, and it comes to us for aid, we're going to deny it that aid. And if it fails and that sends a shock throughout, causes the public to lose confidence and everything, we're going to make sure that that initial shock of the failed institution doesn't spread throughout the whole system by making it known that we'll make enough money available to the whole system so people can carry out their payments arrangements. And so that's what, you know, so Bagehot himself was really aware of this fragile structure of interrelationships between counties and counterparties, you know, counterparty risk and all that. He described it very well.
Yeah, I'd like to ask something about this difference between illiquidity and insolvency.
Mm-hmm.
In principle, it sounds like a kind of straightforward idea to have the central bank as a bank of last resort. But if you talk about this good collateral that banks in trouble have to supply, there seems to be something paradoxical there. Say those who don't need it will get to you because they have good collateral. And wasn't that, say now, part of the problem? So how, in practice, are you, as a central bank, going to distinguish between illiquidity and insolvency? And for example, a lot of these, what we now call bad loans, were rated AAA, and turned out to be not so good. Very good question. And the fact is that when the lender of last resort has to make a decision, it's very hard to disentangle illiquidity from insolvency. It's almost impossible. And so that's why they you know, had that thought that we'll charge them, we'll make them offer us really good collateral, and we'll make them offer collateral that's worth much more than the value of the loan, and that'll be a way that we will kind of a rough test to try to distinguish whether a bank is solvent or not. The other thing is that your initial statement made me recall that famous poem of Ogden Nash. Says, there is a rule, and woe betide the banker who does not heed it. Never lend any money to anybody unless they do not need it. And so you're kind of saying that for the central banks seem to have that rule. But the answer to your question is that that they really didn't make that hard and fast a distinction. Well, they did, you know, as a theoretical matter between liquidity and solvency. But then they said that we know in the rough and tumble of making a decision, we have to make it quick to decide whether a would-be borrower is sound or not. The only test we can use is to make him offer a lot of good collateral and be willing to take the hit of the penalty rate, and that they weed them out, you know. But that doesn't solve the problem.
No, it doesn't solve the problem.
So it's a good idea to let Lehman Brothers go.
Yeah, right. That's well, I think the Fed, I think that problem was caused because the Fed really doesn't have a well-articulated, it kind of knows the classical theory of the lender of last resort, but it says it can only take you so far, and we've gone far beyond that. But the Fed has never really articulated a consistent LLR, lender of last resort policy. Certainly hasn't made that available to the public. And it seems to solve it by a case-by-case rule, you know, rather than having a case-by-case decision, rather than having a firm rule that it applies to all cases and makes known to the public so the public will know exactly what to expect. And so I think in the case of Lehman Brothers, you know, the Fed bailed out Bear Stearns,
and then it let Lehman Brothers fail, and then it bailed out Citicorp and AIG. That makes very little sense. If it had a consistent policy, well articulated, it might not do that. It might have saved Lehman Brothers. So that's the Fed's fault.
Chris.
Yeah, I was just, I mean, it was a similar sort of question, which was that, I mean, did they really have any alternative to recently to bail out these banks? And I mean, should the rule have been, well, we have to bail out everyone in that sense? I mean, what essentially I'm asking is the alternative. I mean, it seems you're presenting this story that they had a mentality which wasn't the lender of last resort, and was one that was actually, well, we are the omnipotent controller of the money supply, and that's perhaps why they did bail out all these banks. Is that the argument you're making? I mean, do you think they could have really done anything different? Should they have bailed out Lehman as well?
I think what they should have done, go all the way back to the long-term capital management in 1989. Instead of, they didn't really bail them out, but they got the bankers together and formed a consortium to bail out long-term capital management. So the Fed people felt the Fed was implicitly behind it. I think the Fed should have said, well, let's let long-term capital management fail. And then if that failed, it would have been a big shock to the system. But later on, the Citicorps and the AIGs and the Bear Stearns and people like that will have seen the earlier example where the Fed didn't bail out long-term capital management, and they wouldn't have done the things they did, which led to the systemic problem. So the Fed had to bail them out. You see, so I think if the Fed had made that consistent, it wouldn't have happened.
You know, there's a problem developing here, and that is the distinction, the antipathy between a lender of last resort and what the Fed is now. Given what the Fed is now, it can't be a lender of last resort. It's simply got to say, we're going to maintain a stable price level and let all the chips fall wherever they will. It cannot be saying we're going to bail out this and bail out that, because it's gone beyond its institutional reality. Is that it's no longer a lender of last resort. In fact, it never was really. We're trying to apply standards to it as a lender of last resort, which don't fit. It's got complete control of the money stock, and if it has that, it has a responsibility of maintaining the value of the money flat, constant, just like the Constitution says. Coin money, regulate the value thereof, and fix a standard of weights and measures and of foreign money, coins. And that's that.
Follow up?
Yeah, I was just going to say, if only you've done a better job perhaps in doing that, looking at the money supply in aggregate. Because I mean, maybe it doesn't have this lender of last resort function, but then it hasn't really done the other side of the job either during the boom times. So that's kind of, you know, it only seemed to, it was still allowing banks to do all kinds of monetary creation without actually controlling the money supply at all. So it didn't really seem to adopt either.
You're saying it didn't do a good job of controlling the money supply? I think you're exactly right. I mean, it's supposed to do it, and it has the power to do it, but it didn't do it. I think you're exactly right.
Well, the strange thing is that from about the year 2000 to 2000, or maybe 2002 to 2007, the monetary base has been declining very gradually.
No, 2008 it went up like that.
Well, yeah, but I say 2007. So during about 5 or 6 years of this century so far, the Fed was keeping the monetary base well under control, under Greenspan, and I personally think he was not responsible for any of the inflation because I think there are any of the crisis, the financial crisis. I think it's all a matter of Fannie Mae, Freddie Mac, and Barney Frank.
Gary.
So a lot of the talks this morning have been about rules, on finding a good rule for monetary policy, a good, solid, irrevocable rule. Well, we were under the rule, one kind of rule, which was the gold standard. We had the Great Depression. Right. So historically, do you think GDP volatility was lower when we were under rule-based systems rather than when we've been under sort of fiat money, more discretionary-based systems?
Well, I don't really haven't studied this, but hasn't Christy Romer and her husband written an article showing that there was more instability under the gold standard? But Dick can talk about this, give you a dissertation on this, because he didn't really have a real gold standard in this country. He had it was a so-called, Dick, you can take that. But
well, no, if I have to choose between a Federal Reserve System and a gold standard, I'll take the gold standard without the Federal Reserve System. There's no way that you can have the two institutions in control at the same time. Like Thomas Hobbes said, if two men ride on a horse, one's got to ride in front. And in this case, I'll take the gold standard, and never mind the Federal Reserve. It's only when the gold standard was not the cause of the Great Depression. The Fed was the cause. The Fed was overriding the effects that any gold standard would have had. In fact, if the gold standard had been allowed to exert its way during the 1920s, there would have been a significant inflation in the United States, and the gold would have flowed back to Europe where it came from, and would have made it a lot easier for the British to have reestablished the pound sterling at the pre-war parity. But that didn't happen. Benjamin Strong saw that that had to happen sometime, but he said, well, we'll keep the price level stable until things settle down in Europe and the gold can go back that's in the Federal Reserve Bank. But it never happened because he unfortunately died, and Adolf Miller came into got hold of the controls. So, but the gold standard was innocent. It's just as innocent as a newborn babe.
So I think that I really don't know this literature, but I think that the Romers wrote an article, famous article, which they claim that to show that there was greater instability before World War II, economic instability, than there had been after. And then I think that that was subsequent. They were attacked and criticized.
Her initial article actually showed the reverse.
Now is it the
that's kind of the irony of it?
Is it the reverse now?
No, her initial article showed there was just no more instability after than before.
Oh, okay. Okay.
So then taking that together, taking say the Romer result together with say the Alcine and Summers result on central bank independence, which is that more independent central banks have lower inflation but about the same GDP volatility as other countries. That both the cross-sectional evidence and the time series evidence indicate that roughly speaking, GDP volatility is about the same. Crises, panics, boom, bust cycles.
Like you also said, her article,
run.
There was a lot of controversy about her data.
Sure.
But,
first approximation, I'll take that.
Well, if I could ask one question I had for you guys, or all the speakers this morning, about your position on bank regulation. Because Thomas Humphrey, kind of said you didn't want the Fed regulating banks, but he said some other agency.
Well,
are there any free bankers here who think there should be no bank regulation?
Yeah, I tell you, I'm afraid that I would be in conflict with my co-author if I answer. I'll let him answer.
Well, I think that would take it far afield.
I think it needs to be some regulation, certainly, as
well, free
Leland
banking
said.
doesn't mean there won't be regulation.
No.
It means free enterprise in banking. And I think that's all to the good. But we still have to have an institutional framework for that particular industry to function.
I really think we need more regulation, but I think regulators are always behind the curve and fighting the last war, and the people they're trying to regulate